One of the biggest fears people have as they get closer to retirement is this. What happens if the market drops right before or after I retire? And that's a fair question because if you think about it, you've spent your whole life building your savings and now you're about to start relying on that money. So the idea of the market dropping right at that moment you need it feels really risky, and for good reason. For a lot of people, that fear sits in the background of their minds, even if they don't say it out loud or even recognize it. Now, here's the important part. It's not just about the market going down. Markets go up and they go down all the time. The real issue is timing when you need the money. Because when you're working and saving, a market drop can actually be helpful. Let me explain. You're contributing and you get to buy then at lower prices, and you have time on your side. But retirement is a different story. Now you're not contributing. You're in a different phase. You're withdrawing. And if you're pulling income from investments at the same time the market is going down, well, that can create a lot of pressure on the portfolio and stress on you. Not simply because the market dropped, but because you're forced to use assets that haven't had time to recover. And over time, that can have significant impact on how long your money lasts. Now, technically, we call this sequence of return risk, but you don't need to get caught up in the terminology today. What matters is understanding the concept. Timing matters more in retirement. So the question becomes, how do you deal with that? And this is where I think a lot of people get it wrong. They think the solution is to avoid risk altogether, move everything to cash, or become extremely conservative. But that creates a different type of problem because, well, retirement isn't short. It can last 20 or 30 years or more, and you still need and even want growth to outpace inflation. So it's not just about eliminating risk, it's about placing risk in the right part of your plan. So the goal is simple. The money you need in the near term, the money that supports your income today, shouldn't be exposed to the kind of volatility that could completely disrupt your life. And the money that's exposed to market risk should be money that has time to rebound, time to recover, time to grow. So what I've found over the years is when you structure your plan this way, a market drop becomes much less disruptive and stressful. You're not forced to make decisions at the wrong time. You're not reacting to headlines, and you have a system, a process. Now, that doesn't mean you ignore the market completely. It just means the market doesn't control your life. And that's really the goal in retirement. Not to eliminate uncertainty, but to build a structure that can handle it. Because markets, well, they're going to go down at some point. They always do. That's not the real question or problem. The real question is whether your plan is prepared for the markets when they go down. And when your plan is, everything starts to feel more stable, more intentional, and more aligned with the life you're trying to live. If you want help thinking through how your investments are structured and whether your plan is positioned for that kind of environment, you can start a conversation through the link in the description.